Currently, Manulife has about $21 billion of real estate assets spread between Canada, the US, and Asia. We're in approximately 23 cities around the world, primarily investing in core and core plus office, industrial, and multifamily assets. And in fact, we just added our 23rd city in Singapore with a large transaction last month.
We're extremely busy at First Gulf. We have over 2.2 million square feet of industrial under construction in the West End. Some of it as a general contractor, some of it for tenants that we've contracted to do buildings with, and others with institutional partners on spec. Same goes for our office business. We're extremely busy in the suburban West market with developments in Oakville and Mississauga, totaling about 250,000 square feet, and obviously downtown, just finishing off the 500,000 feet at the Globe and Mail Center, and soon to be kicking off 450 to 500,000 feet at 25 Ontario Street.
Our philosophy around the shifting needs of tenants is very important because it drives everything we do in terms of our underwriting and our acquisition philosophy. Tenants want newer buildings, they want buildings that are LEED, they want the best in class. So we're always looking at our portfolio in terms of optimization and trying to age down the portfolio and look at bringing on newer and better product for our tenants and our customers.
The e-commerce business has grown without question, whether it's Amazon taking on space in our major cities or the suburbs of our major cities, or whether it's some of the traditional retailers having e-commerce buildings within their current DC, or whether they go outside and have an e-commerce specific DC. It's definitely a demand driver, and it's definitely absorbing space in our industrial markets. There's no question about it. And the challenge in industrial right now is making sense of the economics. You know, where land prices are and development charges and rents, you know, you have to underwrite rental growth in your model today to be able to afford the land prices that we're seeing in the market. So at First Gulf, you know, we continually monitor that, as well as we continue to look at redevelopment opportunities where we can knock a building down, maybe maximize the site. Probably we get closer to the City of Toronto than we were on a greenfield alternative, and hopefully attract that tenant who wants to have access to the growing population.
We've been very active in Toronto. It's our home market, obviously. We're continually looking for acquisitions in the Toronto market. We're continually working on our asset management programs across Toronto by actively leasing and maintaining our existing 5 million square foot portfolio across the Toronto market. We are doing some redevelopment. We're redeveloping Manulife Centre and trying to bring new retail and our tenant Italy to Toronto and trying to drive more traffic in the Bloor Node. In Vancouver, it's interesting. We've been developing. We just completed an office project at 980 Howe. We do believe strongly in that market. In fact, we've been having discussions about further development in that city. We'll continue to look in the Vancouver market for additional acquisitions, both retail, office, and industrial.
In our view, our developments on King Street East are hedged against risk because of our price point. We're considerably cheaper than the core, and in our view, we're going to see rental growth in those markets. I mean, we're a hip area. The millennials like it. We're close to the waterfront. We're close to transit, and transit's only going to get better in those areas. So we think the built-in risk on those developments is going to be a benefit to the owners in the future.
Obviously, people wonder where we are in the cycle with Toronto and the current development cycle. Our belief is that Toronto has very strong job growth and net migration, and we think that ultimately, yes, cycles do happen, but if there is a downturn, it would probably be a soft downturn. It would not be a deep downturn. We think that the imbalances of supply and demand here are more properly suited than they have been in previous cycles. So we're not expecting anything more than a soft downturn when that time does come. And we also believe that, you know, the cycles that normally happen, this cycle may continue to be extended, partly due to the strength of both the Canadian and the U.S. economy.
Toronto adds about 100,000 people a year to the greater Toronto area. And I think that we think that translates to our office business downtown. We think it translates to our suburban business in the West End. And keep in mind, this is most people think that the city is outgrowing the suburbs, but it's not. There's more people moving into the suburbs than there is downtown Toronto.